Beating the market is the holy grail of investing. Unfortunately, as I've explained in the past, beating the market is super duper hard. But some people refuse to believe that beating the market is impossible, and they think there must be some way to invest that's better than just these low cost market tracking index funds. Well, I know of 5 different ways that you can beat the market. Let's go through them. First up, beat the market by not investing in the market. I don't mean to tell you to not invest at all. That's obviously super important for reaching financial freedom. What I mean is invest in a different market. That's because while the stock market is pretty close to an efficient market, in other markets there might be more opportunities. The stock market has thousands of actively traded companies and millions of investors trying to profit off of it. But markets like real estate and venture capital aren't like that. In those markets, comparing two different investments is much more challenging. Think about buying a house. The price of a house completely depends on the neighborhood, sometimes down to the street. So, how recently did another house of similar size and similar repair sell in that exact area? Since the housing market has relatively slow turnover, making an educated comparison can be pretty difficult. So, in this knowledge constrained environment, the local experts might be able to spot good deals and avoid inflated prices. Venture capital is an even better example because most people don't even have the opportunity to invest in the next exciting startup company. And with tremendous uncertainty about which companies will become the next Amazon versus which will fizzle out like the other 90% of startups, expert investors might be able to earn a higher return than an average investor. So, in an inefficient market, beating the market is doable, and you might earn a higher return than the stock market would. But that doesn't mean that you should go rushing to try. In an inefficient market, it's not like everything is underpriced. Some things are also overpriced. There's a reason that most people hire a real estate agent when they're buying a house. If you don't have the expertise you need, you could end up with the short end of a stick. Speaking of expertise, let's move on to the second way to beat the market, which is just knowing more than everyone else. Warren Buffett is one of the most famous investors of all time because he has consistently beaten the market throughout his career. If you were able to spot undervalued companies or have a good sense for when bubbles are about to pop, you could, in theory, beat the market. But, of course, it's turning this theory into practice that is so challenging. Some people really do devote their lives to financial analysis, spotting good opportunities and profiting off of it. So there are professional money managers that do beat the market. The reason I don't do this myself is, quite frankly, I just don't have time to try. Trying to make a better guess than investment firms with thousands of trained analysts and super fast trading times just isn't really how I want to spend the day. So, without the education, expertise, and the time, I don't even try to beat the market. And given how few people do, it must be an extremely challenging skill to acquire. Or at least, it would be challenging if you didn't use the third way to beat the market. The third way to beat the market is just by getting super duper lucky. This might sound like a joke, but I think this strategy, if you can call it that, is actually really important to include. That's because when you hear crazy stories of people beating the stock market by a mile, my guess is most of them used this strategy. It's the same reason that people are fascinated by the lottery. They know that on average, they're losing money. But getting lucky just feels so good. And it's not like being lucky is impossible. Somebody's getting lucky all of the time. But the problem with the strategy is to do this consistently over a long period of time, you need to get lucky a lot. And that isn't so likely. A more consistent way to beat the market is actually super simple. Just take on more risk. Investors will always prefer a less risky investment to a riskier one, all else equal. So, to get any investment, companies with higher risk have to have a higher return. This can actually be seen by comparing the returns of large cap companies, which are typically massive international corporations, with small cap companies, which typically have higher growth potential but have a higher probability of going under. Over the last 50 years, small cap companies have had a higher return. I'm actually using this approach right now. I hopefully have a long life ahead of me, which means I can tolerate the increased volatility now for profit over the long run. This strategy doesn't make sense for everyone. If you're about to retire, you might be counting on your investment returns, so you might prioritize consistency. So, how much risk you want to take on is a personal decision. I wanted to include one more way that you can beat the market, which is by adding your own value. When most people invest in the stock market, they aren't really adding anything of value. They just own a fractional ownership of the company and they hope that asset will produce value. But you can also invest in yourself or do your own work. And this works particularly well if you have an abundance of time that you can sell. As long as you can do something that adds value to somebody else, which almost everybody you can earn money. This return might be better than what you could have gotten in the stock market. And even better, it might not require any initial investment. So don't forget that sometimes the easiest way to increase your wealth is through good old fashioned sweat equity. If you know of any other strategies to beat the market, you better put them in the comments. And while you're down there, maybe hit the like button for watching this far. By the way, this video is actually the fourth in a series I've been creating about the stock market. If you want to watch the first three videos, all you need to do is watch this playlist right here. The first video, I explain the efficient market hypothesis. So I really hope this video added some value to you. I'll see you next time.